we have talked about the 10-step accounting processing cycle. Now I want to talk about 2 steps in more detail. The first one is the adjusting entry, and the second one is the closing entry. So let's first look at the adjusting entry. What is adjusting entry? We just talked about that some of the transactions, they will generate a source document, but not all transactions will generate source document. Some of the transactions, they do not involve an exchange transaction with another entity, so they are not initiated by source document. And in this situation, we record those transactions through adjusting entries at the end of any period when financial statements are prepared. So that is adjusting entry. And there are 2 kinds of adjusting entries. One is called prepayment. The other is called accruals. So prepayment is also called deferrals. And then what are the differences between these 2 kinds of adjusting entries? What are the differences between prepayment and accruals? If we have economic event here, and if cash flow happen before the economic event, that is called prepayment. Versus if cash flow happen after the economic event, that is called accruals. So examples of prepayment, if it is some kind of cash outflow, if there's a cash outflow before the economic event, that is a prepaid expense. Versus if it is a cash inflow before the economic event, that is a deferred revenue. And deferred revenue, we also call it unearned revenue. And examples of accruals. So very similarly, if the economic event is associated with a future cash outflow, that is accrued liability. Oh, sorry. And accrued liabilities, it is also called accrued expense. And versus if the economic activity is associated with a future cash inflow, that is accrued receivables. And accrued receivables is also called accrued revenue. And if you look at some other textbook, it will tell you that it will list depreciation, which is an estimate, as a different kind of adjusting entry. But in this book, it is just, we just clarify it as being 2 kinds, prepayment and accruals. So let's look at an example here. Company A rent a building from company B for 3 months. So which is December 2012, January 2013, and February 2013 at 1,000 per month. On December 1st, 2012, company A paid the whole 3 months rent of 3,000 to company B. So what is company A's journal entry on December 1st, 2012? Company A's journal entry. So company A paid the whole 3 months of rent on December 1st, 2012. Has company A really been using this building yet on December 1st, 2012? So it just started using this building, right? So we can view it as it really hasn't really begun using this building yet. So, but company A paid cash 3,000. So cash decrease 3,000. We credit cash of 3,000. At the same time, it has a prepaid expense. So the expense hasn't really happened yet. The economic event hasn't happened yet. So this is recorded as a prepaid expense. And what is company A's adjusting entry on December 31st, 2012? So on December 31st, 2012, company A has already used the building for 1 month. So now company A can record rent expense because the economic event has happened at this time. So, and then prepaid expense goes down by 1,000. And this is an example of prepaid expense, which is one kind of prepayment. And then if you look at company B, what is company B's journal entry on December 1st, 2012? Company B's journal entry, company B received cash 3,000. So cash increased by 3,000. At the same time, company B hasn't really performed any service or anything to company A yet. So company B cannot recognize revenue at this time. Instead, it should record it as a deferred revenue for 3,000. And then 1 month later, at the end of the month, at this time, company A has already used the building for 1 month. So company B can record revenue 1,000 and debit deferred revenue for 1,000. So deferred revenue goes down. So this is an example of deferred revenue, which is another kind of prepayment. Because for company B, it is also cash flow happened before the economic event. But in different from company A, in company B situation, that is a cash inflow. So that's an example of deferred revenue. And I have another question for you here. So prepaid expense, this account, what kind of account is it? Is it an asset? Is it a liability? Is it shareholders' equity? Is it revenue or is it expense? Please spend 1 minute, think about it. What is prepaid expense? So prepaid expense, that is an asset account. So for firm A, it's actually like on December 1st, cash decreased 3,000, but another asset increased by 3,000. So asset doesn't change. At this time, prepaid expense, it is not an expense because the company hasn't really occurred any expense yet. So it cannot record it as an expense, but the company has paid that money. So this prepayment, that is an asset for the firm. And then for company B, deferred revenue, what kind of account is it? Is this one? Is it asset? Is it liability? Is it shareholders' equity? Is it revenue or is it expense? What kind of account is this one? So for this one, this is actually a liability for the firm. So the company B on December 1st, it hasn't performed any service yet, and it is receiving 3,000 cash. So this 3,000, this is on one hand, the asset increased by 3,000. On the other hand, this is a liability for the firm because the firm hasn't really earned it yet. It hasn't been earned yet. That's why deferred revenue is also called unearned revenue. So that is a liability for the firm. Let's look at another example. So suppose the same situation, but instead of making all of the payments at the beginning of the renting period, now company A was going to pay the whole 3,000 at the end of the 3 months leasing period. So we have December 2012 January 2013 and February 2013. So all of the 3,000 are paid out here at the end. What is company A's adjusting entry? So which means that different from before, on December 1st, 2012, nothing needs to be done here. So our first question begins with December 31st, 2012. What is company A's entry on this date? And this entry, this is called the adjusting entry because the payment is made out here. So there's no outside source document. That is an adjusting entry. What is company A's adjusting entry on December 31st, 2012? It is to debit rent expense, credit rent payable. So in this situation, company A has used building for one month. So the expense has occurred yet. However, the payment hasn't occurred. So this is a rent payable. It is a liability for company A for 1,000. And how about company B? What is company B's adjusting entry on December 31st, 2012? For company B has already rented the building for 1 month. So company B can record rent revenue now because this is at the end of the month. 1 month has already passed. And then because company B hasn't received anything yet, so this is a receivable for company B. So company B recorded as rent receivable for 1,000. And then company A makes the same journal entry for December, at the end of December, at the end of January, at the end of February. At the same time, at the end of the February, it is going to reverse all of the rent payable, and it is going to pay out cash of 3,000. Similarly, for company B, it is going to make this same journal entry at the end of December, at the end of January, at the end of February, 3 times. And at the end of February, it is going to debit cash 3,000 because it's when it's receiving cash. And then it is going to write off its rent receivable. So it is going to credit rent receivable 3,000 to write it off. And then this is an example. This journal entry is an example of accrued liabilities. And the journal entry for company B, this is an example of accrued receivables. Because on both of these situations, economic event happened first and cash flow happened at the end. So this is about adjusting entries.